There's nothing like a little options chain glitch to really add some fuel to the fire of today's breakdown, and we'll see what sort of conspiracies become of that one. But Meta earnings are suggesting a gap down here in the post-market, and there are two major bullish divergences that you need to know about as we head into the remainder of this week. Yes, you heard me right, those are bullish divergences. So as always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of tonight's show. I've got two additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's begin on the SPY daily time frame chart. What do we see here from a trend perspective? The trend is certainly down on the higher time frames. Even here on the daily, we have managed to find ourselves a daily soft lower high underneath 425. The reason I would call it a soft lower high is just because we never actually flipped into an hourly uptrend to set the lower high, but it is still structurally relevant, being back down underneath the origin of the counter trend breakout in the first place. And clearly, we also produced a lower low on today's session, so all the boxes are checked for daily prevailing winds to be down, weekly prevailing winds to be down at this point in time. You'll also notice that we have a rejection and a cleaner close away from our daily 200 SMA, which is the green moving average on your screen. However, it's not that straightforward for new money shorts here at the 416.75 level, because any look at a higher time frame chart, let's start with a monthly, might suggest that we're retesting the neckline of a very important inverted head and shoulders, right? This on the monthly time frame has the opportunity to present a higher low. Here is your inverted head and shoulders. This, of course, is the neckline. We broke to a brand new higher high on the monthly trend count. We're not talking about from here to here lower high. We're talking about from here up to there higher high. And this, of course, pullback could produce a higher low with lows, and higher lows. Now, this isn't a picture perfect world because there's nothing saying that we can't undercut that a little bit, find a higher low in here, and then start to move in the upward direction. But the main point is to start thinking about what is the risk reward profile of this overall location. And I would start to argue that new money shorts are not ideal here. If we take a look at a weekly time frame chart, the ideal place to start thinking about new money shorts would have been setting the lower high on the retest of the double top neckline. And we talked pretty clearly about that over the last couple of episodes. So now that we find ourselves on the lower low, and mind you also our weekly 50 SMA, the blue moving average on your screen, coming into the retest of this level right here, again, what's the risk reward profile for a new money short? Really not great. You're shorting into a known area of market structure. And once again, even if we do undercut this by just a little bit, you're talking about dealing with a really congested range back here from in the past. It doesn't seem like a straightforward short. Now, once again, I'm not calling for a major reversal. As we just saw on the daily time frame chart, there's really nothing about this that would suggest an imminent trend reversal and trading back up to the pivot highs way back up here around 455. Far stretch of the imagination here. But new money shorts might be difficult to pull off. That's the main aspect of what I'm trying to get across. Let's take a look at this trend channel just to illustrate that. Yes, again, there's really no bullish indication. We've broken the major trend channel from a head and shoulders perspective, right? The measured move might suggest a move all the way down here towards that 411, the midpoint of the godforsaken range, if you will. And, the other common pattern that's being thrown around out there right now is the inverted cup and handle. That's certainly a possibility. All of these things would suggest the same, that the bears are totally in the driver's seat, but we're approaching this key structure. So I just want you to start being mindful that new money shorts for anything outside of an intraday trade really aren't all that favorable. Let's take it from a risk reward perspective, right? Let's take a look at the weekly anchored view apps just to reiterate that the October low and all-time high anchored view app, which are the darker gray bands right here, are just underneath us. Once again, risk reward up here for a new money short to target this area, fantastic. Risk reward down here to target that area, absolutely atrocious. So I would not be thinking about, again, anything outside of an intraday trade as a new money short. As a matter of fact, you can go over to the old Bird app and see that I pointed out, I'm actually adding to the long-term portfolio as we're testing this area right here. Let's take a look at the, we already had the anchor view up, so let's take a look at the fibs, right? Because the fibs also might suggest, if we just throw on the clean drawing set here from the low all the way on up to this most recent high, you also have your 38.2 Fibonacci, which is perfect confluence with the structure here. It's almost exactly where we're trading. Why is this important? Because if this is technically going to turn into perfect weekly bull flag consolidation and eventually break in the upward direction, you really don't want to spend too much time underneath the 38.2, and you can see that we're barreling into it for a weekly lower low with confluence of the anchored view apps, the whole 9 yards that we've been referring to. The last thing I'll sort of point out here is the volume profile, because this this is perfect confluence as well. This high volume node, I get it, there's a higher volume node down here closer to that 411 level, but 416.75, basically where we're trading right now, is the beginning of this high volume node. We've already rotated through the low volume void. So once again, risk reward for a new money short down here really doesn't look all that attractive when you're looking at it from this view. Let's move on down to an hourly time frame chart and go the opposite direction, get more granular on a smaller time frame chart. And it's pretty clear here that, I mean, obviously we're in an hourly downtrend, lower highs continuously being produced, and we just broke from low, lower low, lower low, lower low. We produced a brand new lower low on today's session as we covered from the daily trend perspective. So once again, not making the argument that we're blasting up to a new pivot high. I just want you to be aware of the structure that exists underneath us. In terms of if the hourly trend was going to reverse, if we were going to produce a firm daily lower high, this suggestion was for an inverted head and shoulders with the right shoulder building out after repairing the thin structure, I shouldn't call it thin, but the improper end of the auction from back here at 420.50, right? We never actually took out that neckline. We never actually produced a higher high, and therefore, once again, soft daily lower high. So the downtrend is still alive and well. If anything, you could look at this through the lens of an hourly bear flag, and we've just broken down for day one of the breakdown. Usually you can push for day two follow through, right? So what does that actually look like? Let's add a couple more studies on here and we'll talk explicitly about the path. Overall, if you're looking at your anchored view apps from an intraday perspective, we're underneath 4 for 4, bears in control. If you take a look at your Fibonacci's from the high of the move all the way down to the lowest low that was produced today. Just a reminder that we have beautiful confluence with the 38.2 for bearish consolidation underneath that 425 level. So once again, this is a pretty clear indication that a major trend reversal will not be underway until we can, at minimum, take out 425. And there's nothing about today's daily bar that would suggest that, the hourly trend that would suggest that. As a matter of fact, intraday, you can see the attempt for a lower high underneath that 420.50 before continuing into the afternoon. So explicit pathing here, what are we looking for? The most bearish outcome is obviously just straight up continuation. Our next big downside target is 412.50 in the lower bound of the expected move. That's mostly aligned with the intended measured move from the head and shoulders we saw on the weekly alternate drawing set, right? Around 411 was what that was projecting. So 412.50 is structure underneath 416.75. If we find ourselves trading at that area, I would not be overly bearish. Once again, this is intraday trades only. You could look for a slip and lower high to trade the momentum in the downward direction when and if we get here. Certainly changing tone and looking for the momentum to slow down, right? Because we're into that higher time frame structure like the monthly neckline and the weekly retest level, right? If we do start to see some consolidation or a counter trend move develop, and by counter trend, I'm just talking about something like this, it's still incredibly bearish to find a lower high underneath 420.50, rejecting this prior low as well. So nothing changes to the bull side of the market if we're underneath 420.50. If we find ourselves trading on a higher low over 420.50, I would entertain the possibility for some sort of very loose double bottom to be performed like this. But once again, what's that major breakout point? It's 425. You really need to clear 425 in the upward direction if something more substantial is going to happen. And even at that, you have the opportunity to search for a firm daily lower high on any rejections underneath. I would say Jerome Powell's volatility breakdown, which is at 429. Over the weekend, we were tracking 430. I'm a believer that 429 is a little bit more accurate at this point in time. Once again, there's no suggestion of a higher time frame trend change, but there is the opportunity after producing a lower low to look for a counter trend move. So the main pivots that you would want to be paying attention to, I would argue, are 425 and 420.50. If we're underneath, bears totally in the driver's seat looking for 412.50. If we're above, I would look for an interaction at 425, and if we can breach it, things might start to neutralize a bit, but really not holding my breath for a major trend reversal. With that said, let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I think it's fairly straightforward to say that the bears are in the driver's seat here with substantial outflows on Monday and today's Wednesday session, getting very close to that negative 300 million mark. Net flows on the week aren't terrible, only negative 287 million. Substantial reads there are usually negative 500 million or positive in the case of a bullish rotation, right? Advanced decliner is clearly bearish, spending most time under the zero line on the Monday session. Look at the negative divergence out of the advanced decliner as compared to the equal high that's here in the ES price action. And today's session, very close to trend lower zone. The cumulative tick really just speaks for itself. So nothing major to point out here other than, again, bears are in control. The one thing that you might caveat is just, okay, if today was really an aggressive breakdown, if everything was getting sold off, why were we not technically in trend lower zone? Why did we not breach negative 300 million, right? So from that perspective, maybe it's not as bad as it could have been, but it's certainly not a bullish indication. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, what's going on with our value area and point of control? I think taking a second to look at Monday's activity is really important here because Monday attempted to rally. Obviously, there was a big afternoon pullback, but look at where the value area and more importantly, the point of control were left on that individual session, certainly lower in the overall range, especially that point of control. So not much progress was made there in the upward direction. Don't get me wrong, Tuesday is breakaway in the upward direction, as is the point of control. But look at today, down here, we certainly have value clean to the downside, big move in the point of control to the downside also, underneath Monday's point of control as well. We rotated rather rapidly through the thin structure in the A period post back down over here, which, mind you, was a decent excess low. And look at the low from the session on today's move, right? We have a poor low technically. Now, the indication is for a gap down, once again, because of Meta earnings, taking about a $9 haircut there. And if we do get a gap close, any interaction with that will repair the structure. In terms of upside, technically this level as well is a mechanical level in need of repair. You have a value area high of day, which lacked material excess, and then you maybe took it out by one tick. So once again, I would argue we have a lack of material excess at the top, maybe not one tick, a point or two, maybe at most. But in the current volatility environment, I would argue it's not really an excess high. So that still furthers the point of your daily soft lower high instead of a stronger lower high being produced. If we retest 4280, which is the major level in the ES, that should, in theory, break on a subsequent test. Now, we have to get there in the first place, and once again, there's no indication about this offering a major move in the upward direction. So overall, the main takeaways from a market profile perspective is that value has shifted lower, point of control is lower, we have a poor low, even if we go gap fill reversal, that repairs the low, and then we can see if we start to find stronger supports at the higher time frame structure underneath us. To give you an idea in the ES, let's go back on over to the platform over here, and I'll give you that number in the ES underneath us. We're really looking for about 4160. 4160 is your major low for the consolidation on the monthly chart for our ES futures. Let's change gears over to the Nasdaq. Of course, we're looking at the QQQ daily time frame chart to kick things off. Certainly in an overall higher time frame downtrend, similar concepts to our S&P, finding a soft daily lower high around 359.50, certainly inside of our prior balance range from back down over here. We are not close to our daily 200 SMA at this point in time, but we did close underneath the bottom of this range and certainly broke to a new lower low in the overall trend count. Now, there's more of a concern for larger downside on the Nasdaq side of things specifically, because if we do the same thing and look at like a monthly time frame chart, for example, you can clearly see that we're far away from the retest level, which is much closer to 320. And instead, let's take it down to a weekly. What you'll notice is if this was technically going to be a weekly range, remember we've talked about this as a concept, if this was look below and fail because we never actually closed a weekly bar underneath, you needed to stay over that level, and look at where we're trading now, obviously underneath the bottom of the overall range. Different pattern traders might suggest that this is just nothing more than a descending triangle breakdown in the context of maybe a bull pennant on like the monthly or weekly chart here, but the breakdown through the bottom certainly does not trigger or suggest any sort of long-sided breakout. And again, if we look left, there is thin structure to retrace until we get back down to our key zone closer to 320. So the suggestion for further downside is much more severe out of something like the Nasdaq market at this point in time. What do we see if we throw on, let's go ahead and fire up a clean drawing set and just take a look through the lens of our anchored VWAPs here on the Nasdaq. So again, rejecting for that lower high, we're at this anchored VWAP, which is incredibly important because that kind of marks, a last line in the sand. Notice that there's really nothing else to anchor to. And again, you have that thin volume, that thin structure to retrace into 320. So looking pretty dismal if we start to accelerate underneath this level, which is not the same as the S&P. So the way that you want to use these in combination, really in tandem, would be if the QQQ continues to break down to achieve its structure closer to 320, you probably don't want to be looking for an aggressive monthly higher low in the S&P until we get to this area down here. The only saving grace for the Nasdaq at this point in time is if we come in with a fib from the low up to the high, is that we're still over this 38.2, and if we come in from here up to here, we're sitting right on the 38.2. So you do have confluence with this and your anchored VWAP, but the weekly structure is certainly not suggestive at all of any sort of major, reversal back in the upward direction to keep the overall bull flag or pennant, if you will, intact. A breakdown of this weekly range is fairly detrimental from a structural perspective. Let's go on down to an hourly time frame chart and kind of just explore a little bit more of the nuanced price action. Hourly downtrend, absolutely, with lower highs continuing along the way, lower lows, breaking to a new lower low on today's session. Nothing about that will really change. As a matter of fact, I just forgot about something. This also just leads to a threat, right? Here's the volume profile on the QQQ weekly. So just as a reminder, right? Because you need to be aware of the differences between the two major indexes. We're not even close. Not even close. We're in the low volume void. If anything, there might be a little blip of support here at 340 from a volume perspective, but once again, that's still suggesting major downside. So just, again, understanding the differences between the two, much more of a larger threat for continuation lower out of the Nasdaq market, retracing a lot of the AI mania breakout. Okay, with that covered, let's go back to the hourly chart now. We just talked about how, yes, we are technically in a downtrend, lower lows, lower highs. If this was going to be a trend reversal, just like the S&P, you needed to move over those equal highs. We find ourselves closing underneath the bottom of the weekly balance here at 352. So what are the situations? What do we really have to be thinking about? Let's throw on the fibs, the anchored view apps from the intraday. Then we'll talk about the path. Again, 4 for 4 underneath, bears totally in control. These will start to barrel down this and this, at least on that 359.50. That's almost the equivalent of 425, has the same importance of 425 on the SPY chart, right? So if anything more substantial in the upward direction is going to happen, you really need to take out 359.50 in your QQQ. Nothing about today's daily close, also paired with meta earnings gap down, would suggest that's a higher probability outcome into the end of this week. Look at the intraday lower high underneath the right shoulder mark of that pattern we were just talking about. 355 is that number. And lastly, let's just take out the fibs. There's two fibs here. If you come in from the high to the bottom of the move, pretty darn good with your 38.2 confluence right here. If you come in from the balance range highs to the low, if we could get a click, thank you, Thinkorswim, it's pretty much spot on as well, right? So two suggestions. Either you continue the lower high, even worse than 359.50, or even if you get to 359.50, you're still dealing with this 38.2, keeping the bears in the driver's seat. So we understand that upside does not really change until we breach that higher. What about downside? I mean, clearly the most bearish consolidation is underneath 352. Downside targets will be at 346.85. Anything underneath that, we're talking about 340.50. You can just see how this range really opens up as we start to retrace some of that thin structure from the AI mania breakout. And once again, this is different. We are not sitting on strong monthly support like the S&P is. So if you're favoring new money shorts, hopefully it should be very clear now that the QQQ, the Nasdaq market, is where you want to be. If you're looking for the market to reverse back in the upward direction, your tightest risk-reward setup is actually over in the S&Ps, putting a stop just underneath this area of support, looking for a rotation in the upward direction. Again, no indications of that yet, but from a location perspective, S&P's long, Nasdaq short. In terms of what else? I think that's really it here on the QQQ. Let's take a look at what we have from an internals perspective now that we've gone through the hourly, right? What do we see on the internals for the Nasdaq? Certainly breaching the substantial outflows on today's session, really more mild on the Monday session. We did get in trend lower zone over on the Nasdaq here, and look at how bad the cumulative build has been over in the tick for the Nasdaq. Look at what's going on here with the meta earnings gap down. Again, makes much more sense to be a short over in the NQ and the Nasdaq side of the market right now as opposed to our S&P 500. Let's take a look at what some of these future levels might be. If we take out 14,338, it's lookout below. Let's go to something like a 4-hour chart here, and we'll just maximize this. We'll do this in real time and find the next major area that we have to be thinking about if the descent continues, and we're roughly looking at 14K, right? 14K out of the Nasdaq futures is the breakout level from back here, where a lot of that AI mania rally really unfolded from. And let's round out the Nasdaq with, of course, our NQ futures through the lens of the market profile. What do we see over here? Certainly very similar concepts with the value area a little higher on the Monday session, Tuesday overlapping, but look at today's session, certainly lower in the overall range, and we actually have a double distribution on today's session. Notice that this little H period separates the two different distributions. We would call this D1, treat it as literally a separate day, and D2 down here, obviously with the gap down, it means that we're getting a lot of bearish acceptance at this point in time. Even on today's session, look at where the point of control closes. It's in the lower distribution. Of course, this takes out the Monday low. We're just far underneath the weekly balance lows. The point of control closed underneath all of that. Much more of a bearish indication here, and you can already see the acceleration in the downward direction. Incredibly poor structure, poor low, right? 3 TPOs wide at the bottom there, so technically it is in need of repair, but gap fill reversal should be the first thought on something like the NQs here, which are just, again, begging for a thin structure retracement on the higher timeframes, not yet at a key area of support. Shifting gears again to the monthly timeframe chart on the IWM Russell 2000 and the small caps, the monthly chart is just absolutely hideous. There's nothing about this that is suggesting we're coming into key structure. I suppose maybe we're just sitting on the equal low waiting patiently, but trendline players, of course, are looking at this and saying, no, we've already broken down from the trend that was trying to be established, keeping this in what we would consider bear flag consolidation here on the monthly time frame. So overall, next downside targets are really just the top of this range here, which are closer to 155. So a little bit further to fall until there's structure there, and even at that, this isn't really offering much out of small caps. The other detriment is that we are technically trading underneath the pre-sickness highs from over here. So monthly chart looks awful, no major structure to be thinking about. Let's take a look at the weekly time frame. I'm just going to do it this way, move that to week, good to go. And what we'll notice over here is, again, if we take a look at this as a range, we're right at the bottom of the range threatening a breakdown. This as a weekly head and shoulders. Of course, there's not even been a lower high attempt to retest that neckline. It's just been pure domination from the bears in small caps over the past couple of weeks. Nobody wants anything to do with small caps. That's really been the message over the past couple of videos. Let's move on down to a daily time frame chart even and just see the damage that continues to be dealt. If this is a balance range, again, not even an attempt for a lower high counter trend rally. I mean, look at what was going on the Tuesday session. Indecisive doji can't even make it to the bottom of that range at 169. We break to a new lower low on today's session after gapping down. I mean, just nobody wants anything. Don't touch small caps with a 200 million foot pole. Just no interest whatsoever. So what does that set us up with? Let's take a look at the hourly chart. Obviously, taking a look here, you can clearly see that even though we gap down, we closed the gap, which is good from a structural perspective. But if the buyers are going to make something happen, you need price acceptance back in the previous day's range. None whatsoever. We go back down to the low of day fairly rapidly and consolidate sideways into the close. So once again, you look at the chart objectively and you ask yourself the question, does anybody want anything to do with small caps? The answer has to be no. To be really impressed with a stronger turnaround in the broad market, you need to start seeing indications of a trend reversal on something like the IWM hourly. And sitting on a lower low, it's far-fetched, right? You would really need to start to see higher lows up and over 167, but even at that, you still have to contend with that daily lower high on the retest of 169. So pick your poison. There's really no path forward that's clear yet over in small caps. So it's very difficult to have more of a bullish tone in the broad market as a whole. Remember that small caps have really been acting as the canary in the coal mine over the past couple of weeks. And if we even take a look lower, so breaking this, that's the weekly lower bound of the range that we were just looking at, underneath 164, 162.75 is technically the lowest low of the entire weekly range. There's your gap underneath. Remember that we were suggesting 155 from a monthly perspective. There's a daily gap that closes under 157.70 down to 155.90. Now, do you just want to chase this short in the downward direction? It's been a fairly straight shot lower without much consolidation, so I wouldn't be bullish. But again, just start thinking about what's the opportunity for the Russell to just go sideways down here, consolidate out, and then break into the future, right? So new money shorts might not be ideal after seeing this type of extension over like the last week and a half or so. Let's take a look at the market internals for the Russell side of the market. Fairly bearish, again, seeing substantial outflows, in particular on the cumulative reads for the week thus far here. We're usually looking at negative 150. We're almost there. I mean, we're just right there in the Russell small caps. You can see that we have bearish advanced decline line activity on the Monday and Tuesday session. Again, not even an attempt for an equal high here. No attempt for an equal high intraday even on that Tuesday session, and the cumulative tick also bearish in this particular look. Let's take a quick peek over at the market profile, and we'll dive into some more deeper supporting evidence for the broad market. Here's a mechanical level just because it's fairly precise. You have a poor high. Maybe it was repaired slightly. There's a little bit of excess on that Tuesday session, but again, look at your value area and your point of control from Monday. Tuesday is slightly overlapping. I will give credit where credit is due and say that, yeah, the point of control was up, but look at today. Point of control clearly down, clearly down, value area lower in the overall profile, liquidation break off the open from our single print in A period, and decent excess at the lows as well. So we don't necessarily have as poor of structure at the very bottom of the move, which once again might suggest that new money shorts at the bottom aren't really achieving much. There's no structure, there's no auction that needs to be repaired. You might want to just tap the brakes for new money shorts and just say, okay, we're bearish overall, but actually continuing to trade downside, risk reward not all that favorable yet. You want to see a break and retest underneath. If we just go back on over to the platform, we'll fire up the IWM. You really want to see, like on a weekly time frame, a break, retest, lower high, and then you're continuing in the downward direction. If we're just chopping around in here, again, it's bearish, but there's really not a long setup. There's really, there's no long setup and also no short setup. Let's take it one step further for the broad market and check out the performance of our sectors on the week. The XLU for utilities is leading here, up 3.22%, which is a slight concern, noting that we did have the beginnings of a counter trend move. Counter trend move led by a defensive and also lightweight sector is not really what you want to see if you're looking for a stronger reversal. So this does stack up as a more bearish data point, seeing the relative outperformance. Same thing with the XLP, D for defensive and also lightweight. The XLK finds itself green on the week, but only by about 1/4 of a percentage point. That's fairly concerning, noting that Microsoft gapped up big time this morning and the XLK actually faded and put in a bearish engulfer. We'll see that in terms of the structure in just a moment. Energy at the bottom of the barrel down 2.62%. Let's take a look through these charts though and see what's going on. So utilities is still just a counter trend move after the aggressive weekly sell-off. Don't get me wrong, is upward pressure still upward pressure? Is it slightly helpful for the S&P? Yes, but posture-wise, incorrect sector, and also it's not really going to do a whole lot if you're seeing moves like this in the communications sector and over here in the XLY down about 0.5%. Again, upward pressure, but such a lightweight sector and not the right posture that it doesn't give me a warm and fuzzy feeling inside, even if it's starting to look like a constructive weekly high or low. Don't forget about the possibility for a weekly lower high. I mean, all of that is technically on the table. Let's take a look at the XLP. It's the same story. So if it does break out over this level, don't get me wrong, upward pressure is upward pressure, but same story, lower high, and really not where we want to see the improvements for our market. Here's the XLK and where the damage was mostly done in my eyes for today's session. Notice the bearish engulfer after Microsoft's earnings caused a gap up. So there it is on the structural chart. And more importantly, we closed right on the lower edge of the overall weekly range. This really shouldn't come as much of a surprise considering what we just discussed over on the QQQ. If this was going to be look below and fail, you need to hold this area for a higher low. And with the bearish engulfer, it certainly does not look likely that we're hanging on to 163.50, especially you can tack on a intended gap down here, 162.81 by 161.50 bid-ask spread. Meta earnings, a little bit of carryover to the tech sector, even though it's in the communication sector, right? So not looking great. Bearish overhead supply. The more time we spend underneath 163.50, the more bearish it becomes for the broad market. Also notice if this was going to be an inverted head and shoulders, you really wanted to hold a higher low and not reject for a lower high. On the retest of that neckline at 166.50, that's exactly where we faded off from. Another bearish indication there. If you are going to change your mind, or if the market is going to suggest more of a recovery effort here, you need a higher low, not only over 166.50, but you need to trade for the equal high here to neutralize your weekly trend. So a lot of work to be done. Certainly does not look bullish. Here's the XLE for energy. This was the global risk off style trade due to all the tensions, right? This is fading now in the downward direction. So lighter weight sector coming back into alignment of an overall balance. Not much to really say about energy. Downward pressure is downward pressure, but again, really lightweight sector. XLC, some damage for tomorrow, right? The intended move here in the little bid-ask spread box is 61 by 63.70. So really wide, but 61 is here, 63.70 is roughly here. So take your best guess. Wherever we open, it's underneath this as an overhead range, right? So bearish breakdown, overhead supply. Even if we do fade the gap, there's a big opportunity for a lower high and continuing downward pressure for the broad market. So not all that helpful, not all that helpful at all. Big breakdown on today's session, even gap down, no attempt at a fade of that gap. It's not looking good for communications, and once again, being a more so risk-on style sector doesn't speak to a recovery for the S&Ps. Here's the XLV healthcare sector breaking to a new lower low. Even though this is D for defensive, it is the second heaviest weighted sector, so to see that new lower low, it's got to be bearish pressure for the market. Let's take a look at real estate. Again, lightweight sector, but here you go. There's your lower low. It's got to be bearish pressure for the market. Obviously, extremely rate sensitive with rates back up around 5% in the 10-year. No surprises there. Industrials back in the midpoint or even lower third of this prior balance range which it broke out of. But what's the story? Again, breaking to a new lower low has to be bearish pressure for the market, even if it's a medium weight sector, right? 8% roughly in that XLI. Here's the XLY, consumer discretionary, much more of a heavyweight risk on style sector, breaking from this as an overhead range. We had talked about the failed breakout a number of times back here. So not only lower low, but if this is any sort of indication of a counter trend move, it's very short lived. Notice that we actually did produce a higher high in the upper wick of Tuesday. So it's a firm lower high. And even if we did rally, let's just say that this turns into like an hourly double bottom or whatever, you're over the neckline, weekly lower high. There's nothing to write home about from a bull perspective on the XLY until we're over 156.75 from a constructive trend perspective, something that does this, correct? So bearish pressure for the S&Ps. Let's take a look at the XLB materials sector, another lightweight sector, breaking to a lower low, well underneath this as a balance. I will say that the range double is mostly complete. We have a little bit of a gap interaction down below. Later weight sector, not as worried about this one. Last but certainly not least is the XLF. Definitely more so worried about this one, right? Weekly resistance, attempted to act as support, weekly lower high, and once again, breaking to a new lower low. It was really that Monday move in the downward direction. Look at the upper wicks on the past. Really, it's the weekly bar. If you were to look at a weekly bar, this is just all upper wick, right? It's rejecting the entirety of this breakdown. It's rejecting this prior low. That, of course, strikes me as a bearish indication. XLF being a heavier weight risk on style sector, not really looking good for, again, improvements in our S&P. So everything is still bearish. Again, there's no argument here for a stronger trend reversal in the upward direction. Everything is postured bearish. You might just want to be mindful of the structure that we're sitting on, and we'll talk about the two big divergences in just a moment here. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. For the most part, the only saving grace for the risk-on look right now is what's going on with the XLK. It's over an upward sloping 50 SMA, but that's all we have, right? If you take a look at the healthcare sector, it's sideways over a flat 50 SMA. The XLF is underneath a descending 50 SMA. XLY obliterated with Tesla earnings, obviously, in a downtrend underneath a now descending 50 SMA. XLC is going to get even worse tomorrow morning with the gap down from Meta earnings, getting underneath this long-standing period of outperformance. No longer the case. If you look at the risk off sectors perking up over the 50 SMA now in the XLP as well as utilities over here, suggesting much more so of a risk off posture for our market. Let's take a look at some specialized ratios. We've got the XLK over the the SHY. So we're talking about bonds. This is one that I finally just made a preset for. And remember that at first glance, this looks the same, like it's just a mirror image of the market, but it's actually not. Notice that we broke to a lower low here, whereas this is trying to hold on to a higher low. That's one of the minor bullish divergences that I think you should be paying attention to. If this can hold up, it might suggest that, again, being a new money short down here is not favorable. It doesn't suggest an imminent reversal to the upside. And again, there's no bullish argument to be made, but new money shorts down here, this might say, hold your horses, right? Let's take a look at the XLK over the XLU. This is the classic relationship, and this is fading in the downward direction once again, speaking to risk-off odds. Let's take a look at the XLY over the XLP for apples to apples, and this is breaking to a new lower low. That, again, would suggest risk-off odds. Let's take a look at the dollar. What's going on with the Dixie? You can see that it's consolidating over the top of the original range from back here. As we know, that in theory should put downward pressure on equities. That is not helping the case for a stronger big trend reversal. So you can see how the pieces of the puzzle start to come together here. Let's take a brief glance at gold, just because this is coming into an interesting inflection point. If gold continues higher and pulls back, that might finally be the catalyst to send the dollar in the upward direction, furthering downward pressure here for equity. So just watching that, if 2030 causes a harsher reaction to the downside, might cause the dollar to actually get out of its own way. Remember that these are moving in sync because of the flight to safety, so to speak, and the global tensions, as we've been saying. Let's take a look at the 10-year yield. What's going on with the TNX? TNX, where is it in the list? There it is. Again, 5%. You're not seeing it here on Thinkorswim, but we do have records of 5% over on the 10-year. From a purely technical perspective, break to a higher high, higher low has been found. Again, from a technical perspective, the uptrend is very well and alive. The next overhead target is really at 5.3. 5.3 10-year. Of course, that has to be somewhat of a headwind for our broad market. It's just a difficult operating environment for companies that really rely on the cost of capital. Let's take a look at what Jerome Powell and the 2-year is suggesting. Another hike, pause, what's going on here? Certainly a higher low. Again, thinking about this from a trend perspective, pulling back from a higher high, it would seem as though the odds are starting to shift ever so slightly more towards another hike. And as we know, the January of 2024 timeframe is really where we have to be slightly more concerned. Let's take a look at the tracker tool and get more granular. The prolonged pause is still very much so on the table as the highest probability path forward, which does align with the inverted ZT breaking for a higher high, but not necessarily a major higher high. So considering the sequence, the higher low, higher high, let's take a look at the January timeframe. And what you'll notice over here is the slight uptick in total probabilities for a hike from sub 30% into the early stages of this week to currently sitting at 36.29%. One more potential additional hike before the back half of 2024, where we're seeing some cuts being forecasted. So why might the Fed raise rates one additional time? Let's take a look at the economic calendar to sort of answer that question. If you look at the PMIs from earlier this week, they came in better than the expectations here. And if you take a look at the GDP, it's slated to come in at 4.5, more than double the 2% norm. So the Fed does not have a mandate around GDP, and they don't have a mandate around PMI. Their dual mandate is for maximum employment, so unemployment claims are slated to come in on par with average, 208,000, nothing blowout to the upside, so labor market remains fine. And if you take a look at the PCE, which is down here on Friday, 8:30, it's currently forecasted for 0.3%, right, which is hotter than what the Fed is aiming for. Usually to get a annualized 2%, you need this to be 0.1s and 0.2s. So if the Fed is losing on this battle, but doing okay on this battle, and this would suggest that, hey, things aren't awful in the economy, things are certainly growing at a better than average pace, maybe there's room for one additional hike. And this is important to talk about because if we take a look at GDP, the Atlanta Fed is usually not all that far off from their estimation. So the 4.5 strikes me as extremely reasonable for GDP tomorrow morning. But it goes further than that, right? If we're talking about recession, big Armageddon style sell-off for our market, what is the main cause of that? The biggest cause is unemployment. And currently, 208,000 is a very manageable level. If you take it one step further than that, you can look at household debt service as a percent of disposable income, and this is fairly low. Fairly low. This is certainly not a looming threat for a big and imminent recession. Same thing if you take a look at delinquencies. I get it. These are quarterly reads. We should be getting updated data very shortly. There's nothing saying that this can't aggressively move in the upward direction, but with the data in hand, if we think about where we're at from a monthly structural perspective on the S&P, at some point on the higher timeframes, like let's concede that the fundamental narrative is what drives price, right? Corporate earnings, if those take a hit, of course, charts will have to move lower. Prices will have to move lower. Nothing about the data in hand is overly suggestive about a dark, deep, dirty recession. None of it, right? This is certainly fine, and the employment data is also certainly fine at this point in time. So I bring this up in today's session specifically to, again, caution you about large new money shorts looking for everything to fall apart as we approach a key structural element on the higher timeframes like the S&P monthly. Of course, Nasdaq has some room to fall. It's not at that structure, but if we're talking about recession, if we're talking about new lower lows underneath the October low, you need to see all of these data points right here really start to more substantially deteriorate, primarily employment, as we just discussed. Inflation is going to, rev back out of control. It's going to be an ugly situation. It's not happening. It's not happening. Inflation is running hotter than the expectations currently, but the labor market remains fine. And because of that, I would argue that, again, corporate earnings are not going to take a major hit. Speaking of earnings, here is the calendar. We've already discussed Meta a number of times tonight, but Amazon is the last big beast into the end of this week, and then we'll look forward to Apple earnings, and NVIDIA, as we know, is on November 21st. Let's get a sense here for the market's appetite for risk. What you'll notice in the S&P ratio to the TLT is that we're still underneath the resistance trend line, so no classic flight to safety style trade unfolding, which is, I wouldn't call it funny, but if there was going to be any beginnings, it should have been when Ackman announced the closure of his bond short. The TLT caught a bid for 2 days, and now it's basically right back down on the lows. So no love from that perspective. This relationship is not all that useful right now. So instead, we can look at the bond market in relationship to itself. And what you'll notice is that we're sitting on the highest highs in these overall sequences, speaking to an uncertainty for longer duration risk assets like equities down below, and a preference for the shorter end of the quote-unquote risk-free government-backed side of the bond or notes curve. So SHY, clearly the preference here. If we take a look at credit spreads, they are widening, but more so on the shorter end of the spectrum. Again, this is 1 to 4 year. If we're looking at the SHY and HYG here, if we're looking at IEF LQD, this is more so a 3 to 7 year suggestion. So it's not the longest term. Obviously, TLT is 20 years, but notice that you're back down at the high breakout point, right back down at that high breakout point, whereas in the shorter end, you've produced a substantial move and you're not back down at that 1.09. So if you're in the camp of looking for a monthly higher low, this would actually be a bullish data point, right? The fact that this is not aggressively accelerating, don't get me wrong, it's still widening. It's not helpful to the bull case, but the immediate term is the threat and the medium term isn't quite as bad at this point in time. Let's take a look at the HYG. In the intro, I mentioned two bullish divergences. This is one of them. Remember that the HYG was the first to break down for a lower low ahead of the S&P just sitting on the equal low. And now what you'll notice is the HYG is suggesting a higher low from oversold conditions to get a little bit of a bullish divergence going on. It's been fairly accurate in the past couple of cycles. It is something that would suggest even if you don't want to be long, it's probably not wise to be a big new money short looking for the market to go to hell in a handbasket. Let's take a look at Bitcoin, what's going on with the digital gold, breaking out of its balance range from up here. If anything, this speaks to a risk appetite for just financial systems as a whole, right? If everybody's scrambling, looking to pull out money and paying for, their obligations, usually Bitcoin's not going to outperform like this. And obviously the breakout would say otherwise. So this is a risk on kind of indication, which again agrees with more of the monthly analysis of saying, hey, there's an opportunity for a higher low here. Let's take a look at some breadth indications because these are not as pretty. New highs versus lows is almost unchanged on the week. So you might say, oh, great, the market moved lower, it's unchanged, that's got to be bullish. Well, not when we're this far underneath the zero line, right? It would certainly be more constructive to get to the zero line and then stay flat. Remember, early on in the stages of trying for a recovery, you don't have to have these blockbuster reads up around 500 plus. You can kind of hang out sideways near the zero line as the market tries to make a recovery effort. So this being negative is the concern. What's going on with the SPX A200R? This is pushing for a lower low. Just as an FYI, typically your oversold rebound comes from achieving at least a 20% read in the SPX A200R. Not quite there yet, maybe suggesting that it's not going to be a clean resolution of your monthly higher low. Something that is interesting though and continues to support the idea that, okay, new money shorts probably not favorable. This is the second divergence that we were talking about in the intro with the SPX A50R. Notice the higher low in this with the lower low over in equities. This, once again, even if you don't want to be bullish, even if you don't want to swing long, it's not really a warm and fuzzy feeling for anybody looking for a major drawdown in equities. The only thing that might counter that narrative is looking at the weighted S&P versus the equal weight S&P. So this sitting on this low, if that gives up at 135.80, let me open this up to a multi-year chart. You'll notice that the October lows are back on the table, right? So if only a select number of stocks need to continue to pull in the downward direction for the equal weight S&P to move lower, that would suggest that, again, NVIDIA breaking down, Apple breaking down. You might not add more stocks trading sub the 50 SMA. Your SPX A50R might not actually produce a lower low, but this breaking underneath 135.80, a little bit more of a concern. The October lows are on the table. Same story over here in the QQQE, which is the equal weight Nasdaq, obviously. And the main thing to point out is that all of the AI mania rally has been retraced, right? We're talking about a move back to or even underneath at this point the monthly structure before the breakout. So talk about places to be short, it's probably the Nasdaq, not so much the S&P, as we've pointed out thus far. Let's have a look at the Dow and what's going on from that divergence perspective. Transport's breaking to a very aggressive new lower low, whereas industrials are just sitting on the lower low. Obviously a headwind suggesting that we should likely make the move towards 31,750, which of course, again, bearish for the broad market as a whole, not looking for a major market reversal. Last but certainly not least, let's jump into some volatility, and then we will be on our way. VIX is certainly suggesting the likelihood of a break once again up and over that 2050. This does not speak to a comfortable bottom yet in the S&P. Capitulation style bottoms usually at least get to the 30 handle. We have not seen that yet. So one more flush, get this up to 30, and then a stronger hold of the monthly higher low, possibly. Let's take a look at the VVIX volatility of the volatility index, trying to get over the 103 again on today's session, but unable to do so. We'll be keeping a very close eye on this one into the end of this week. If we start trading back up here again, I think it's the precursor for one more flush to the downside and then catching for that monthly higher low. So watching VVIX rather closely. Let's have a look at volatility futures, and what you'll notice here is that we did close technically in a backwardation over the zero line. Just as a reminder, this means that there's more risk in the present day versus at some point in the future. In the case of this spread, it's a monthly spread, right? We're looking at the November versus the December contract. So money managers would much rather wait to allocate capital once volatility volatility has settled down instead of right now in this moment. This is a headwind for the market in terms of money flows. You can see clearly that the one-day VIX is also elevated. It has not broken out of this range, but overall 2 bullish divergences, a lot of bearish data points. So I would argue big lower lows, big shorts, probably not unless you're in the Nasdaq, but we're not looking for a major reversal back in the upward direction. We're not swinging for all-time highs just yet. If you've made it to this point in the video, do me a favor, hit the thumbs up button. I certainly appreciate you coming out to the show, and let's get along with our core list of companies. Apple, lower high being produced underneath the bottom of the prior balance and the top of this 4-day range from back down over here, with the equal low suggestion at our daily 200 SMA. Not usually a good look. A break there gives you the equal low on the daily for a gap close around 167.60 down towards 167 flat. Here it is on the hourly time frame chart, just to illustrate that if this is going to be a double top, we did reject the neckline on the lower high intraday today below 172.50. So as long as that's the case, as long as we're down here, bears do have the upper hand. To be bullish on Apple, I would need to see some sort of higher high being produced over the 174 level. Let's take a look at Netflix. Netflix is on the table for a continued short squeeze after hitting that 419 level, looking for any higher low pullbacks that sustain themselves over 405.50. Here it is on the daily time frame chart, keeping all of the shorts squeezed who are participating down over here. So once again, that looks something like this. Equal high break gets us through some of this thin structure retracement. The next target overhead is 436.75. Next up, Tesla. What's going on with Mr. Musk's boring company failing to really resolve that daily 200 SMA in the upward direction? Hammer candle not producing a substantial counter trend move. No higher lows over the 218.50 mark. Let's take a look at the hourly chart here. If this was going to turn into a more convincing inverted head and shoulders, again, your neckline wanted to break with price acceptance above 218.50. Not the case, and now the flush is clearly for a lower high underneath 212.25 to trade back down towards that head at 204. Google is up next. Earnings candidate certainly gapping down big time into this morning session. I was a little bit more hopeful that we would have found some support in an overall uptrend at the bottom, this key area of support around 127. Certainly not the case. So now it's a gap overhead and it is a gap underneath. Treat this for exactly what it is. Thin structure overhead until 132.15, 134.25, and then the gap close at 137.50. To the downside, you can see from back here the prior earnings cycle, the gap closes at 123. Even if I had to give you a next support underneath, I would be really looking at the low of this pullback closer to 118.50. We will refine that for tomorrow's session. Here's Meta. Let's have a look at the hourly chart because again, earnings after the close are not going so hot. You can clearly see a move in the downward direction. For the most part, I would be thinking about a fade of the gap and not overly aggressive on the short side ever with a big gap down like this. But for the most part, let's go back to the daily. I want to just illustrate, look at what we're gapping down from. I mean, the trend here is clearly up. We find ourselves at 289s. 289.50 is still like right around in here. So still in this consolidation zone, breaking this micro uptrend, but in the grand scheme of things, we're unchanged from this box up here towards the top. You could look at that through the lens of like monthly bull flag consolidation, right? So not the end of the world for Meta, but again, taking it in stride tomorrow morning, we will have to create a new drawing set. So we'll just do that for now as a reminder to do so in the pre-market prep. Here's NVIDIA. Everybody and their sister, right? Let's talk about the head and shoulders. There it is. The neckline is coming into view at 400. We are not there yet, but this as a lower high failing the balance break. Here it is on the hourly chart. Let's go extended hours off. And what you'll notice over here is if this was a 2-bar range, originally 1 and 2, look below and fail, fantastic, and now look above and fail, we find ourselves at the bottom end of the range. So the short trade has pulled off, or it has been completed, I should say, and the next major short is underneath that neckline, right? Really underneath that neckline on the daily is 400, but to get there, breakdown on the hourly under 412.25 opens the door in the first place. I would be waiting for a lower high underneath. Look at the volatility in here. I would certainly want to see something like this. That way I can posture with a stop here, enter here, and look for a target down there. Looking for something like that as a 3-to-1. I would not just be willy-nilly shorting this in here before the break or before a lower high to place a stop loss. Next up, Microsoft moving in the opposite direction to Google this morning, giving us some push and pull. Here it is on the daily time frame chart, gapping up out of this as a range, but also out of this as a weekly range. And you can clearly see in the lower wick of today's session the attempt to hold for a higher low above. So if that continues to hold, a squeeze can unfold over 340.80 to squeeze out any intraday shorts who are still holding that short to the opening print of today's session, which I'll give you the exact number. That is at 345.02. 345.02 becomes the first target, then your prior high, the last lower high in this head and shoulder sequence here at 351 is the upper target. Here it is on the hourly time frame chart, so you can see that, right? So aggressive shorts for the fade. Anybody who is late to the party squeezes up and over the top of that flag consolidation, 340.80, target opening print, and then 351 as we were just discussing on the daily. Obviously, underneath 336.85, which is the daily balance that we were just looking at, the gap continues to close closer to 331.50. Last but certainly not least, the mini beast, we've got Amazon, then two additional trade ideas for you. This is a balance range break. So there it is on a weekly. Underneath 124 is hideous. Earnings are on Thursday. That's tomorrow after the close. So keep your wits about you. Implied volatility is going to increase here. I will not be touching this from an options perspective for that exact reason. If I looked at the daily time frame chart, this is fairly concerning, right? As a rounded top, as a head and shoulders, whatever you want to classify the pattern, breaking down underneath this level right here opens the door to some of these lower targets. We have 118.20 and 114.15. Daily 200 SMA is tangled up in there. We'll just gauge it for a reaction. It's not a do or die area of support at this point in time. First trade idea on the chopping block outside of the core list is MMM. Triple M, 3M is the idea, and basically look at the relative strength, right? Obviously earnings gap up, but on today's session, not breaking, producing an inside bar right at the highs of this prior area, obviously net short. If we start to take that out, I would have to imagine shorts start to cover, and we might see a rotation towards this upper gap, maybe just the origin of the breakdown bar there, around 92.64. So, you know, that's a pretty substantial range on a sub $100 stock at this point in time. Here it is on the hourly time frame chart, just to show you where the idea is invalidated. It's on any price acceptance underneath that 88.83 mark. If we're trading underneath the 2-day balance range, not really interested. If we're trading in here, the thesis lives on. And again, a break of these equal highs opens the door to the top. The origin of the last breakdown at 92.64. Next, and truly last for tonight's video, SNOW. Some struggle with cloud computing and what's going on based on Google's earnings, right? The cloud continues to be the issue. Let's go to a daily chart and just illustrate the magnitude of this level, right? Look at how menacing that shelf is at 142.50. Big bearish bar on today's session, closing extremely weak with momentum into this equal low. Look at the proximity of time also decreasing, right? Decreasing and once again decreasing. What else is happening? Of course, some sort of lower high phenomenon. If we start taking out 142.50, looking for a larger short out of snow to continue this in the downward direction, the next major level to be paying attention to is closer to 134.15, just shy of roughly 10 points underneath us. But the spirit of the trade is a short with lots of overhead supply weighing on price in the downward direction. That's going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Don't forget that we will be live tomorrow morning as well as Friday morning for Core PCE at 8:15. Always live at 8:15. Hope to see you up in the penthouse. Donuts and coffee on us for Friday. We'll see you there. I wish you a green trading week.